All right, so let's look at private equity, a very, very interesting space. So when you're looking at private capital per se, we have private equity and private debt. I'll cover private debt separately. All right, let's focus on private equity right now. When you're looking at private equity investments, so there are 3-4 ways of investments the way we are looking at it. One is you're investing in a private company directly. When you're investing in a private company, say suppose there is Sobisco Biscuits, a large company in Calcutta. Let's say they want to expand operations, they want to start selling biscuits and manufacturing biscuits down in South India. So right now they are not at a stage where they can go for an IPO or they want to go for an IPO. I'm just giving an example, I just randomly thought of a name. So when I'm looking at that, you're investing in a private company. Why do you want to invest in a private company? I'm assuming that the private company scale would be relatively on the larger side. The scale of private company would be relatively on the larger side and you see potential in terms of expansion and all. So that is a simply making an investment into a private company. The other way of investment would be investing in a public company, but that cannot be private equity. You're investing in a public company in order to take it private, in order to make it a private company, then revamp it and then probably launch it again. We generally do this in case of leveraged buyouts. I'll come to that. Then we have venture capitals and all. So LBO, this will be more of LBOs where you're taking a public company private and you want to relaunch it later on after revamping the entire company. It is not necessary that a leveraged buyout has to be a public to private story. It is possible that maybe you are interested and you're buying out a private company, then you revamp it and then again sell it off. Or maybe you buy a private company and then convert it into a public company and launch it into an IPO. So it could be a public company, you take it private, revamp, then again public. It is also possible you take a private company, revamp, it is at that scale probably, and then go public. That is also possible. We'll come to leveraged buyout, but this can also be a leveraged buyout. This would in more likelihood be a leveraged buyout because in order to take a public company private, you need huge amount of money and you need debt capital for that. Right? You need a huge capital. Then you have venture capital, early stage companies and all. Startups basically, we'll focus on this. Then there are 2 other categories which is a very small proportion of PE funds. So when you're looking at private equity investments and all, these 2 are relatively a smaller category. So distressed investments, so at times companies are in a very bad state and they might, because of over pessimism or over selling of those stocks or those shares, the prices might be even below their fair value. At times it happens the stock is trading below its fair market price or below the price at which you can probably sell all its assets. It's basically trading at a value lower than the book value also or lower than the fair value. As in, even if you sell the assets, land, building of the company separately, you'll probably get more money than what the stock is offering you, than what the stock is currently priced at. Happens in extreme situations, and retail investors like us would not want to get into that because 1, you have to analyze and identify that stock, and 2, you'll have to take that risk and be confident and invest that kind of money. So distressed investments, primarily distressed investments are in the form of debt capital because in distressed companies. Then you have developmental capital funds. So developmental capital funds would be, it could be for a public company, it could be for a private company. Say suppose Airtel today says that I want to raise a certain amount of money, I want to go full 5G, and because of that I need a certain amount of capital, I need a 2,000 crore rupees or 1,000 crore rupees, and I will return it in the next 4 years or so. But I don't want to go for another FPO, follow on. So after IPO, Airtel is already a listed company. If you issue new shares in the market, that is known as a follow-on public offer, FPO, right? But Airtel probably does not want to do that. Let's say if it does not want to do that, that will be developmental capital finance, developmental capital, right? Developmental capital funds. So it could, and where you're not investing, you're not taking a majority stake. Understand, when you're taking a public company private, you take a majority stake, you revamp the company. How can you revamp the company? If you're controlling more than 50% of the company, if you're running the company, you can revamp. You can influence decisions, you can change the management, run the company the way you feel like. But here that is not the objective. So understand the difference between the different types. Here you're not running the company, you're a minority shareholder. You will only own maybe 5%, 7%, 8% of the company. The objective is that the company might have an opportunity. Let's say for example, Amar Raja Battery right now needs a certain amount of money because they want to expand in order to cater to the EV space. So they want to expand into the batteries for EV. and therefore you contributed a good amount of capital because let's say it's an opportunity which is in the short term going to be very fruitful. So you can contribute this capital for a public company or a private company. Developmental capital, let's say there's a short-term opportunity, there is a Snowman Logistics. I think I had mentioned this company last day or last class or some other class probably. So that is into cold storage. So maybe because of the vaccination drive and everything going on, they need immediate fund. They cannot wait for 6 months to go for an entire public shares, public raising process and all. So maybe you just contribute in terms of that, in terms of developmental capital to capitalize on that short term. So public, it can be contributed towards a public company. This can be funding for a private company in order to expand, in order to take up opportunity, take advantage of any opportunity in the short term. That is what we're looking at. If this investment is made in a public company, we call it PIPE, Private Investment in Public Entity. PIPE stands for Private Investment in a Public Entity. So if you're investing in a public company, understand, you've invested in a public company, but that investment was not through the stock market, through the regular public stock market route. It was privately invested. So say for example, when Airtel is raising the 1,000 crore from you, it's not giving that offer to public that anybody, all of us can apply for the IPO, for the FPO, for the subscription of shares and pay money and then we get the shares allotted and all. That is not what is happening over here. Tell me, are you following this? That is not what is happening over here. What are we doing over here? We are basically raising money for a public company. We are investing in a public company, but we are investing privately. That is why it is going to be categorized under private equity investment, because it is not open for public at large to invest. Although you're investing in a public company, we cannot invest. And you're understanding the difference over here and here. Here you want to control, revamp the company in your own way and control the company when you're taking a public to private. But here when you're investing, you're a minority investor over here. You just want to contribute towards that developmental capital, towards that opportunity so that they don't miss out on that. Tell me, are you following this? Comfortable till here? Alright. Next, when you're looking at how it works is, so normally we'll study the structure and all separately, but we have, let's say, when you're looking at a private equity fund, there is a fund wherein people contribute and invest money. So there are people, limited partners as we call them, they will be just investing their money. We call them limited partners. So these partners are going to be only contributing money to the fund. There is somebody called general partner. General partner is going to be responsible for managing the fund, deciding which company I want to invest in, which company I don't want to invest in. So it's simply like a partnership firm where there are partners who contribute money and do not run the business, do not take any decisions. And there are partners who would be the decision making and general partners will also have their investments, so that these people also have risk, that if they do not manage and if they are lightly investing into companies and the whole investment is going bust, then these people are also involved and their money is also at stake. So general partners also do invest. General partners also do invest, right? But the management and the decision making and the choice of companies and investments and all rests with the general partner. Limited partners are only supposed to be contributing capital. We will study the structure of private equity, hedge funds and all separately. But they invest in the PE fund. General partners decide which VCs or which LBOs to invest in or which public companies to take private, which investments to make. These companies in which the PE fund is investing, they are known as portfolio companies. So say for example, in my portfolio, I've got an ITC, I've got a Tata Motors, I've got a Larsen & Toubro, I've got a lot of stocks are there. Relaxo I don't have. Reliance, I have a little bit of Reliance. So when I'm looking at these stocks in my Grasim, I have Grasim is a good buy. So when I have these, I'm not sure whether it's a good buy right now at these prices. So I hope I'm not making any miscommunication. I'm not making any stock recommendations over here. So but then these are my portfolio companies. So when a PE fund is investing, they're investing in private companies. These companies become the portfolio companies of the PE fund. So they are known as portfolio companies of the PE fund. And in these, the VC managers are involved. I told you that over here, you're not controlling over here, you're not revamping over here. But when you're investing, when you're taking a public company private or a venture capital and all, the VC managers are involved. They'll sit on your board of director, they'll guide you, they'll do all of these things. I've barely seen clips of Shark Tank India, but when you're looking at the Shark Tank US, which I've seen very extensively, I think at least 5, 6 or 7 seasons I've seen. So when I'm looking, of course, forward karke, but when I'm looking at the Shark Tank over there, so don't you? I don't know if you've seen that. If you followed the series, great. If you haven't, please make sure that you people do when you're studying VC and all. Start watching the season. It's really interesting to see, and you learn things. You at least see how the VC space. You get a glimpse of it actually, but the point is that there are a lot of startups at times I've seen where, say for example, one of the sharks, one of the investors have offered them that I'll give you $3 lakh, let's say for 10%, and another investor is saying that I'll give you $2 lakh for 10%. Mostly it's Lori in that case, and she's saying that, oh, I'll give you only 2 lakh or 2 lakh 50 for the same 10%. The investors at times go with Lori because she can use her TVC or whatever network and all of that to launch the product, to market it. Or say, for example, if somebody is entering into the apparel business, then Fubu, Damon is going to be helping with the Fubu and his brand, and he understands that business very well. So maybe investors, even if they get less money for the stake, lesser valuation, they might go with one of those sharks. Why? Because the sharks bring their expertise, their guidance, their network, their experience into the startup. So that's why it becomes an advantage over here. So that is why we're saying that the VC fund managers are involved. They at times serve as a director on your board, and they'll be giving you direction and guiding you and all. So it is very important to choose the correct people when you're working with them in your startup, in your business, as your business partner. It's very important who's bringing what to the table. You cannot just do business with your friend because you wanted to party, it'll be great, work will be like play, and it does not work that way. You have to see what an individual is bringing to the table and how business could be sustainable. Tell me, are you understanding this part? Clear, comfortable, easy? Next, when you're looking at private equity strategy, so now in order to execute these strategies, taking a public company private and investing into a venture capital and all, so broadly we are looking at 2 categories. One is a leveraged buyout and one is a venture capital. Venture capital we already easily understand. It's startup companies, it's early stage companies. I'll get into it later. Leveraged buyout. Now what do you understand by leveraged buyout? Leveraged means taking loan. You're taking a huge amount of loan, and then you take that huge amount of loan in order to buy out a company. Buy out a company cannot be a minority investment. You're buying out a company. You're totally owning a company. You're totally getting a controlling share in the company because you want to run the company. You think that you can revamp the company and get a much better valuation. Maybe I can invest in a company at, let's say, $200 million, and I can make it into a $400, $500 million in the next few years. I can increase the profitability, the cash flow of the company, and I can create value, I can generate value. That is the confidence I have. And that is what I can see based on my experience and all. Maybe the company is not doing very well. The company may not be in a position to take loan and borrow money and revamp and do it and run things their way or get back on track. But PE fund, because of the amount of capital and all that they have, because of the kind of resources, the kind of investors they have, it might be possible for them to be able to raise loan at a cheaper rate. The company is not raising loan. The PE fund is going to be raising money, taking debt capital and investing into these leverage buyouts, So we are going to be buying out a public company. It could be a private company or more likely a public company. We'll be buying out that company, revamping it, and then again going for an IPO or again selling it off to the public at large. See over here again, private equity investor. See, if I am running my own business, that is my private company. I have a private limited company. I'm running that. I do not have an intention of ever selling that company. A private equity investor, when they are entering, they do not have the objective that I am going to run this business, then my children will run and then my grandchildren will run. They're not looking at it that way. Understand the difference. So the private company you own is not private equity per se. Are you understanding this? Because when you run a business, you want to run it forever. Grow it. That's your thing. That's your business. But when a private equity investor is looking at it, there is more of it is looking at value creation and monetizing that value creation. When investors are investing in this private equity fund, they do not want to invest it forever. That it is going to go on, this investment will stay for generations in my family. It's not your grandmother's ring. Sorry, I mean, you're understanding. The objective is I have a horizon of 10 years, 8 years, 12 years or so, or maximum 15 years, ideally 8 to 12 years or so. In that 8 to 12 years, I want that value creation and I want to double my money. I'm taking a lot of risk. I'm investing a lot of money over here, not for retail investors. Tell me, are you understanding this? So when we are looking at this, the objective is that I'm going to be buying out a company, leveraged buyout by taking a huge amount of loan, revamp, and again sell it off in the market. I'm not there to run the business. I'm here to revamp and get out of the business. That is leveraged buyout. So leveraged buyout, one of the most common ways of buyouts, because for VC and all, you'll have to figure out newer markets and it's very risky. Venture capital is very, very risky. But here it is less risky. It is very risky in the sense that you are taking a lot of huge amount of loan and all. But it is very less risky because it's already an existing business. If it is a publicly listed company, it's already at a very good scale. And there is a proven track record, a history of cash flows and everything. And you know much more. You already know a lot of things, how to run the company. It's not a new business. It's not a new patented technology or something. It's something that is there is a lot that you know. There is more certainty because of that. Of course, there is a huge amount of loan and that is going to add on to risk. Leveraged. The term, if you convert a public company to a private company, we call it going private. We term it as going private. Tell me, are you following this? So leveraged buyout could be either an MBO or an MBI, management buyout or management buy-in. The difference is that if the existing management is going to remain involved, so suppose I buy out a public company, if the same CEO, CFO, etc. will be involved, it is just that I'm going to be controlling, guiding them, restructuring, revamping the cash flows, doing all of that, but I'm going to retain the management. In that case, it is termed as management buyout. If I'm going to throw out the entire existing management, maybe I was of the opinion that they're inefficient, corrupt, whatever be the reason, or not suitable to the kind of the way I want to run it. There are different people who might want to run the organization in a different way. Maybe the management wanted to run it in a more conservative way, and maybe you want a management that replaces and takes things more aggressively. Sorry. Tell me, following this? So therefore, if you replace the existing management, the entire management is out with a new external management. You bring an external team, the CEO, CFO, everybody at the top. It's not that you have to change every single employee, every single team member. In that case, we call it a management buy-in. The management is also replaced, management buyout or management buy-in. So LBOs could be when you're keeping or retaining the existing management, we term it as a management buyout. And if you're replacing the existing management with an external management, we call it a management buy-in. What is the objective? We take a public company private by buying shares, getting it delisted. So now again, we don't have so much of SEBI guidelines and regulations of the stock exchange and all to cater to. There is less focus on me. Management also, what happens in case of public companies is that every quarter you have to release your reports and everything. Now the management is too pressurized, they have to cook books, they might have to cook books, or not might have to, it's very wrong of me to say that. They might get inclined to cooking books and because there is market pressure and investors pressure, why is the price down? You are doing business, it takes a couple of years, you take decisions to impact the company in a long-term period. Every quarter you cannot be expecting good revenue, high revenue and all of that. There could be seasonality component, there could be business cyclicality impact and all, but at times shareholders and analysts and all may not understand these things. Ultimately, the management is running business. You run business properly, in the long term, the stock is going to do very well. But again, the stock market vigilance is a bit too much to handle at times. That is why taking it private. So now we don't have to answer to analysts, etc. There is no stock market price pressure, etc. Right now, the focus is totally on the business aspect, the business front. How do we revamp? By having a new management, maybe. Management incentives are more aligned to that of the company. That if the stock price does not increase, if the profitability, if the cash flow does not increase, this much cash flow, this much will be your salary. So more better incentives, restructuring, maybe restructuring debt equity ratio, restructuring the whole, revamping the whole company, reducing cost. There are a lot of companies where there is a lot of leakages, cost leakages, etc., cost drivers and all. So you figure out ways in which to reduce your cost and increase your revenue. The PE fund and all, because these people may have a lot of other companies they've invested into. There are a lot of portfolio companies, right? So maybe this company and this company uses raw material from this company. So I will use my connections and my portfolio companies, because one, I also have a controlling kind of a nature in these companies. I will try to utilize that in order to do cross-selling between my portfolio companies, increase revenue, reduce cost, use my synergies and all. And then using this, I will try to increase cash flow of my company. I will try to, and I will also have to pay my debt because it is a leveraged investment. Leveraging is also amplifying. So leveraged growth, the idea was amplifying. People have questioned me earlier on that. So private pay debt, and that is why high cash flow generating companies are a target. So basically when I'm looking for, when I'm scouting, it's not that suddenly I will get a dream and I will know which company to invest in. So how do you scout? PE funds also have to look for companies to invest in, right? They'll have to evaluate, they'll have to filter out private portfolio companies that they want to invest in. VCs, LBOs, target companies. So which companies will be targets? Something that is highly cash generating or relatively cash generating and which is operating inefficiently right now. Or there is something wrong with the company, the business or the situation. Maybe the company suffered a reputational risk. What do? You buy the company, change the branding, brand name, etc. and revamp the whole thing. And people at times spend a stupid amount of money also on these things. Which one? Grofers na Big Basket became Blinkit na? Big Basket. Grofers. Grofers became Blinkit. I'm not saying that is a bad one. I don't know. I've not gone into the details. So generally the target will be that high cash flow generating businesses is what I would want to invest in. I don't want to invest in companies which will take me a few years to revamp and turn cash flow positive and all. And also it is not an early stage company or a startup or something where my cash flows will be negative. I'm already doing business. It's already a running company, a private company that you've possibly taken private, a public company that you've taken private. So it is already a company that is into the business, operating, etc. It's just that I want to revamp it, I want to double my cash flows, I want to make it more efficient in every possible way. Once that is done, because it is very important, because I have to service my debt, because of the huge amount of loan I took, leveraged investment, and once that is there, once the cash flows are good and all, I'm going to be relaunching it, reselling it in the market through an IPO or something. See, understand, companies, say suppose a normal company in, let's say, in the construction sector, let's say the company is going to be trading at a 15p ratio. Suppose the company has been doing badly because of delays in projects, this and that, and debt and high debt and all of these things and all of these issues. Let's say the company's share price right now, the earnings is 10 and the company's share price is 15 into 10, 150. And I know that the company, if the efficiency improves and all, in a couple of years, I can take the profitability from 10 to 20. My share price will increase from 15 by 10 to 300 by 150 by 10 to 300 by 20. I'm assuming the P ratio will remain constant. If I assume that the company's earning is 10 and the price is 150 right now, the P ratio is 15. Even if I assume that the P ratio is going to be constant and if I'm able to make my earnings 20, don't you see the price is going to become 300 at the same P ratio? And in fact, the P ratio also increases. You'll study P ratio and all. So in fact, the P ratio, the price earning ratio of the company will also increase if the risk of the company is going down, if you see growth potential and all. So if, say for example, because the company is now revamped and there is a new avatar of the company, absolutely. So in that case, if the P ratio turns to 20, then see the share price is going to be 400. Do you see how much of value creation can be done over here? Multiplicative effect that you can see over here. So this is what the LBO targets. This is what we're looking at in an LBO target. That can I revamp the company? Can I make it less risky? So when you study equity valuations and all, you'll understand that if the company's risk goes down, your discount rate goes down. If company's future growth potential goes up, the valuation increases significantly. So can we do all these things and resell it in the market, IPO and exit? So this is what we're looking at when we're looking at the leveraged buyout. LBO se question hai?
So not very like LBO se.
Tell me.
So like does it ever happen like this, like in real life, for example, like
real life, yeah, these things can happen. So Jet Airways, for example, was trying that Etihad buys out Jet. So they were trying.
Again, they would have come back.
Again, they would have probably, or they might have merged it absolutely into their operations itself. Of course, they can happen. Let's move to the venture capital part. When you're looking at venture capital now, obviously we're looking at early stage companies. So somebody investing in Swiggy when Swiggy was absolutely starting off with, let's say, 10 bikes or 20 bikes. Or a Nykaa when it was just at the stage of developing or getting the website done. Very, very early stage. When you're looking at venture capital, please understand that the risk and returns are extremely high. Out of 100 startups, 90 startups fail in the first 3 years of its inception. First 3 years of its inception. This is the normal data that you would, this is normally what the data shows. So when I'm looking at the startup space, it is very, very risky. It does not make sense to give loan to a startup. What happens in debt and equity? There is asymmetry, understand. In debt, what happens? I will get a fixed amount of return, 8%, 8%, 8%. If the company goes bankrupt, my money is gone. In equity, what happens? You can get return. You can get absolutely any amount of return. Whatever, if the company earns beyond 8% or after paying all the interest cost and all, whatever money is left, whatever is the value creation, whatever is the profitability, etc., goes totally to the equity shareholders. Upside potential is huge. And even if the company goes bankrupt, I don't have to pay anything from my house. Whatever is my equity share price or whatever is my investment, that becomes zero. Now your question would be, why would somebody invest into debt? Because debt is less risky. Because first, even if the company goes bankrupt, you have to first pay the entire amount of money to the debt holders. Then if anything is left, will go to equity. And even if you have no profit in any particular year, you'll have to first pay the amount of, you'll have to still pay interest to the debt holders. You don't have any such obligation to the equity shareholders. Tell me, are you following this? Understanding this? In venture capital, what is happening? Especially when you're looking at these startups and all, they don't even have a lot of asset base. That, even if the company goes bankrupt, you'll sell the office building and this and that and be able to pay off the debt holders. No. The probability of downside potential is very huge. And you cannot make money because you are going to be getting only the interest cost, nothing beyond that. So nobody is a fool to invest into debt of a venture capital, of a startup, because the probability of losing the money is very, very high. And the probability of an upside is limited only to your fixed cash flow, 8%, 7%, whatever is the interest, even if it is 12%. Tell me, following this? Next, when we are looking at equity. So obviously the downside potential is there, that I'll lose my entire invested capital, but there is a huge upside potential. Even out of 100 or even out of 500 startups, if one of them turns out to be an ICA and I invested at the absolutely beginning stage, I'm still going to be able to recover all the other 499 investments that I made. But even out of 500, will you be able to spot that one ICA or that one unicorn, Udaan, whatever you're looking at? So that becomes a question. So risk and return is very, very high. And that is why the form of investment is either in the form of equity or convertible preference share convertible debt. It has to be convertible. Preference share and debt, it's going to be somebody's going to be a fool to invest. Why convertible? So that the convertible part gives you an advantage that even if the startup goes bankrupt, first the debt holders get paid off, then the preference shareholder gets paid off, and then the owner, founder and all, whoever has equity, they will get paid off. So there is one advantage. And at the same time, if the company becomes hugely successful, I can convert my preference or debt into equity shares and gain from that upside as well. Tell me, are you following this? And startups, founders who need to VCs, who need to raise money, they might want to issue these convertible preference or debt in order to attract capital because they're desperate for money in order to grow, in order to sustain, in order to do business. Tell me, are you following this? Right? So, and obviously the returns would be tremendous if a startup is successful, if your VC investment is successful, it leads to an IPO stage or a major, or you're able to sell it off to another investor at a very, very high valuation. So that is what we're looking at in venture capital. Now let's see venture capital in a little more detail as to the phases or the stages of a venture capital company. When you're looking at a venture capital company, when you're looking at the investment stage, normally the categorization is done based on the stage at which you enter into a startup. So is it a seed stage funding, Series A funding, Series B funding, you must have read about when you're going through articles around startup space and all. So at what level, at what stage of the startup did you invest? Obviously, the earlier the stage, at the earlier stage, if you're investing at a much earlier stage, the risk is very, very high, but the return could also be very, very high if successful, because here the valuations will be very low because the company is at a more of an experimental stage. As the company grows, becomes established, gains brand name, consumers, users, etc., their valuation increases, and the startups who enter at later stages will have to shell out a much higher amount of money in order to get a stake. But their return would be lower because they're buying the company or they're investing in a company at a higher price, but their risk is also lower because the company's already got a little bit of a proven track record. They've got some market, they've got some market validation done, they're already launched. So depending on which stage is the startup in, depending on which stage are we investing in, we can categorize the VC investment into 3 stages: formative stage, later stage, mezzanine stage. Within the formative stage also, we can look at investments into at 3 levels or at 3 time frames. The first one is the angel or the pre-seed stage. Understand the words, understand the meaning of the words, because otherwise you'll get confused. When I'm looking at angel investors, so basically without that angel, wo farishta, without that angel, you would not have probably even been able to kick off your business or start off your business. That is the first amount of capital you get. You just have an idea. Let's say I have an idea of building something, I want to build an app. But I need a good chunk of money in order to get the app done, the UI UX done, to buy the server and everything. So right now it is just an idea, it's just something it's just a thought, and I want to convert it. So if I do not, either I will invest the money, or I'll ask my parents to invest the money, or I'll borrow it from friends, relatives, etc. Right? So they are the angels who are investing. It is not even at a seed stage, because there is nothing existing right now. Seed stage will come after the angel stage. At the angel investment level, or at the angel stage or pre-seed level, because right now it's not even the seed that is going to grow, because there is nothing right now. At this level, the people who are investing, it's not the venture capital funds who invest over here, because it is too risky, it is too small an investment to make, and you will just have 1 lakh lakhs of ideas at that stage. Idea ke saath to lakhon log khade hain. Who's willing, who's confident enough, or who's willing to, how much of skin in the game do you have? How much are you willing to risk? So I know we've been working with startups throughout, and one of them right now, when we are working with the one we're working, so he's got his investment and his parents' investment put into it. That automatically gives a little bit of confidence to the investor also, because you are so confident and you are so much invested into that startup, that you put in your money and again your time, effort, everything. It shows conviction. So that is your pre-seed stage or your angel stage, where VCs generally do not invest. It is going to be your family, friends, etc. And it is too early. It is just the idea stage right now. Here you develop a business plan, you develop a prototype, a working model of an app which can be launched, where you want to start testing the market. You've not even started testing the market yet. It is just that where you're developing the plan, your product and your app, or your whatever you're doing, it's just at a very, very simple ideation stage. Maybe then you'll hire a factory. Maybe if you're trying to manufacture a product, you'll hire certain vendors that, okay, you make this part, and then you'll assemble it and you'll build a prototype. So it's not even at a prototype stage yet. At the pre-seed level or at the angel level. Then at the next level, after you've done this, you have some prototype done. But now what you want is, you want to develop the prototype. So here you had an idea, I want to make a drone. Here what you're doing is, you have the drone, but now the drone's capacity is only to carry a weight of, let's say, 300 grams. I wanted to have a capacity of 2 kgs at least, so as to be able to deliver, or at least to be able to hold a camera on top of it. And I wanted to have a range of, I wanted to be able to reach this much height. I wanted to be able to work in windy conditions and take videos of boogie woogie going on in a wedding ceremony or something. So basically that is the product development stage, a market research that you're planning to do. So that is seed stage or seed capital. This capital is in order to get a proper functional working product, understand the market, getting the research and all done, and getting forward with your marketing strategy, raise, and all of those works. So all your homework is being done over here. You're building up on your homework here. Your product to be able to so as to be able to commercially launch. So here you might have a website with a lot of bugs. Here you want proper UI UX done. You want the entire pages done, absolutely up and running server which could cater to even lakhs of people coming in. If you're looking at startup stage, another series I would recommend is Silicon Valley. So you need to get in again. So that's another discussion as to, getting into a startup for the right reasons and the wrong reasons people get into startups. So Silicon Valley is an absolute comedy. It's not educational in any manner, and A-rated, so watch it under parental guidance or whatever. It's full on comedy. But you get to see the perseverance. You get to see the movement of how the startup has been performing, and how they keep on, the kind of challenges the startup faces and everything. And it's pure comedy. So that is your product development, market research stage. Then in the early stage or startup stage, now you're actually reaching the startup stage. Here it was the seed, because you did not even have the product ready. Now you are actually a startup stage or an early stage startup here, wherein you have the product. Now you have started, you have your initial commercial production started. You've started selling. You did not start selling over here. Here you are finalizing the product. Here you had nothing. Here you had a prototype and you had to finalize the product. Here you are doing commercial production now. You've started selling. You've become operational at this stage, at the early startup stage. You are into business now. Tell me, are you following this? Once you're into business, of course you'll have a lot of learning. You'll still be developing, improving your product and all, but 90% improvement would have happened over here. Here it is more of tweaking, getting the feedback from the market, incorporating into my product and all of that. Now I have started selling drones and they are taking photo shots on for these weddings, and they're doing all of that, what do you call it? They probably started delivering very small medicines maybe, and not yet pizza and all. Maybe I'm going to be tweaking. I'll incorporate GPS also now so that they can drop it at the coordinates, and probably carry heavier cameras, and probably I can maybe I can make them, you know, move at in a higher range. I've increased the range of the battery, what do you say, this remote controlled drones and all that. So I'm already at that stage, but now I want to take it to another level. I want to increase the scale. So now I move to the later stage. Later stage is where I want to increase, where I want to expand, because ultimate money part is going to be flowing in when there is volumes coming in. So I want to reduce my cost of production by increasing volume, and I want to sell. I want to increase my volume. I want to increase my sales. How do you increase your sales? Through marketing, and that is where most of the cash burn and all happens for these startup companies and all. A lot of times illegitimately they do cash burn. People start doing their cash burn and marketing expenses over here itself, which is stupid. So there is a level at which you start spending for marketing. Of course you might be spending on marketing, but the level is very low. But here you want to go all out. You want this to become a huge brand, something that every single person in the country knows. Like today, Swiggy's already crossed the expansion VC stage possibly. They already penetrated through most of the cities across the country, right? This is increasing sales through marketing, and obviously you might need to even set up production facilities. Nowadays, most of the cases, what happens is you have job workers, you have different factories you hire, you assemble the product. So things have become more on asset-light model nowadays. Even the bikes and all, Swiggy does not own all the bikes. So it's more of an asset model, light model that companies are working. So therefore it is more about increasing sales. But if you're into the manufacturing space as well, in case you need to manufacture as well, in that case you need to include this expansion stage, which also include setting up your production facilities, increasing your factory sizes, etc. Ola bikes maybe, right? So you're looking at the expansion stage where you want to increase sales, a good amount of production costs, production facilities, etc. All that could also be required over here. So here the startup is already established, it's growing, it is growing. You just want that growth rate to become very, very steep, very, very quick. Capture the market before anybody else is able to enter. And in this process, if you are loaded, if you have that kind of money, in that case, you're also going to be acquiring any small players who try to compete. So you want to become big too quickly, inorganic growth. You start acquiring smaller startups, you're spending like crazy on marketing, cred and all, extensive amount of spending on marketing. They've not left anybody from Kumar Sanu to Anil Kapoor to Madhuri Dixit to advertise, or the entire IPO. I was just discussing cred yesterday in the fintech session. So increasing like anything. That is your later stage. Later. This is early. This is the formative stage. The startup is getting formed. It's nothing. Prototype, established product, started selling, we are into business, expanding business. And here the simple objective is, you want to go from private to public. That phase, that stage, mezzanine matlab kya? Beach ka, mezzanine. So that phase of transformation from a private to a public, that movement, that change, converting a private company into public, that stage, that mezzanine, that difference, that time frame in between, that is your mezzanine stage. So you need capital, capital to launch an IPO and go public, go all out public. That is your mezzanine stage. So mezzanine is not beach ka stage that way. Don't think of it as the startup is over here and mezzanine stage is over here and then the startup will become successful. Don't think of mezzanine that way. Mezzanine is a phase between private to public. This private has also become too huge already. PharmEasy acquired a public company, Thyrocare. They're already too huge, right? So this is what a startup journey would look like. But more importantly, when I'm looking at it from a VC investments point of view, at what stage is the VC investing here? Most likely VC will never invest over here. VCs will enter at one of these stages, and depending on the size of VC or the size of PE fund and the minimum ticket size they have, there could be a startup which requires only 20 lakh rupees or 30 lakh rupees, and maybe a good PE fund or a large scale PE fund may not even entertain a startup at this stage. PE fund may start entertaining startup only at least wherein you are at this stage where you have an established revenue and all. Over here you don't have any revenue. Here you start getting some, you have some revenue to back up your valuations, your data, etc.
So how is the mezzanine stage different from private equity? What a private equity fund does?
So mezzanine stage is also, private equity will enter into mezzanine phase stage also. I am saying that mezzanine stage is not something where you say that startup is starting and now startup is successful. This is not mezzanine stage. Startup has already become successful over here. It has become super successful in this phase itself. It has launched properly. It's working. It is into business. It is already becoming very successful here. Mezzanine stage is the gap between taking a company from private to public. For that you might need financing. Like Nykaa, they wanted to open stores, they wanted to get into brick and mortar stores across the country and all of that. They wanted to go public, they wanted that kind of a, that kind of marketing, that kind of reach, that kind of noise. They wanted to make that kind of noise in the market. Right? So that is your mezzanine stage. Okay. 1 second. So let's look at the exit strategies. So when you're looking at a private equity, we can look at it from more of a VC's point of view. So what are the exit strategies? How do the private equities exit? As I told you, you can be running your family business forever, but a private equity is just not interested. They want to get into the business. Even if they are investing into a venture capital or something, they ultimately want to do an IPO and get out of the investment. They're not there to run it through generations. That is not the idea behind a private equity. There is a time frame, 10 years, 12 years, 8 years. There is a time frame in which I want to create value and I want to generate returns. So there has to be an exit strategy. Ultimately, the private equity they're investing the money right now, they want to in cash. They're investing into portfolio companies right now, they want to in cash. So depending on how successful or how badly your VC has performed, you will have your exit strategy. The best option would be to come out with an IPO. You're so successful, you're so huge that you're able to do an IPO, hire a merchant banker, issue shares to the public at large. So that is going to be the best option for you that you want to achieve. And the worst one would be where you are not able to sell the startup, you're not able to sell your business, you have to write off or you have to liquidate. So nobody is willing to acquire your business. You sell off the chairs and tables and everything that you bought. Nobody even purchased your app. The app is scrapped now. So you absolutely shut down your office, you sell all the assets and all that you had, square off all the liabilities as much as possible, and your business is zero. It is shut. Liquidation. You sell off the entire business, you write off all your losses because obviously you're not successful. That is why you have to write off and shut down the business. That is the worst possible outcome of an investment. The other ways of exiting could be, the next best method I would want is to be a trade sale or a secondary sale. This would, according to me, would be one of the other alternatives, other good alternatives. Secondary, say, trade sale would be, say for example, Myntra selling it to Flipkart. There is a strategic buy, right? So when you're looking at one of the startups in a similar phase, let's say even Facebook acquiring Instagram or WhatsApp, there is a lot of strategy, there is a lot of synergy, there is a lot of sync, there is a lot of value creation possible because of this. So there is a strategic buy. Maybe a backward integration or a forward integration or something. Google, Yahoo, these people, Microsoft acquiring them. So Microsoft acquiring LinkedIn. So that is a strategic buy. And let's say for example, one PE fund buying from another PE fund, that is a secondary sale. That is a secondary sale, one PE fund. So my PE fund is owning 10 startups, your PE fund is owning 10 startups, you buy one from me. Maybe because you have another company in your portfolio wherein you can merge and create value. Maybe I have a startup which is into, let's say I have an e-commerce website into t-shirts and for men, and you have an e-commerce website selling t-shirts for women, and you want to buy the men one and you want to combine those two into a single website and single platform to capitalize on marketing and brand creation possible. So that could be one PE fund buys another and then they try to influence, because ultimately the PEs are influencing and controlling the startups. So maybe you want to do it that way. So one PE buying from another PE. Tell me, following this? And then you have your recapitalization. Recapitalization might sound a little weird. Recapitalization is not exactly exiting the business. Say suppose I have invested a huge amount of money in this XYZ company. That company, maybe I invested 100 crore rupees. Now what I'm doing is I'm not selling the stake, but what I'm doing is I'm drawing profits in the form of dividend. I have already received 20 crore, 40 crore, let's say 70 crore dividend I've received. I have not exactly exit the business, but don't you see that I have driven out a lot of profit from the business? Normally when you're looking at startups or early stage companies and all, you don't take the money out because it needs that capital in order to grow. But by taking a good chunk of capital out, I'm kind of trying to recover my investment, trying to take my investment out. I have not sold the stake, but I want to take the money out of my business and make it my personal wealth. I'll give you an example over here. It is not exactly it's not exactly recapitalization that was done, but there was one of these interviews by Zerodha's Kamath, and somebody was questioning him that, why are you drawing a salary of 100 crore or something like that. So he said that Zerodha is already a very successful organization, and I want to draw a certain amount of money out. It was either salary or some way he was taking the money out of Zerodha, and he said that I also want to diversify my portfolio. I do not want my entire money to remain into one company, and what if something goes wrong in the future? You never know. There is nothing certain today, right? So obviously you want to take a certain sum of money out. So say suppose you had made a 100 crore investment and the company is worth 400 crore today. You take out, even if you take out 100 crore worth of dividend, you're actually taken out the amount of investment, at least my capital is safe, my investment to nikal gaya mera, my investment is out. This is not exactly exit, but ultimately you are tending towards exit, or at least you're safeguarding your principal, or you're taking a good chunk of money out so that you're more on the safer side basically. So this is more like payback, or this is more like taking my money out or taking my investment out, at least reducing the value, reducing the value over here, reducing the bulk of investment over here. So you're not exactly selling your stake, selling shares or something. It's just that you're trying to take out some profits and not leave it in that company. So you're trying to reduce your risk in a way. So that is recapitalization. So you're giving heavy dividends to yourself. Recapitalization. Tell me, comfortable? So these are the broad exit strategies. The first, obviously the best is ideally IPO, and worst being a write-off or a liquidation. It is possible that a secondary sale or a trade sale also gives you a huge valuation, especially a trade sale and all. Right? It is possible you might get a very good value over here and you might not want to go for an IPO. It's absolutely possible.
So IPO, when it's an exit strategy, is only for the PE, right? Only for the private equity.
Yeah, we are talking about private equity. If it's already a public company, how will you go public again?
Oh, even the write-off is for private only.
हाँ ठीक है, this completes this part.